this is basically an attempt made by me and my co-author, Giuseppe Colangelo, to look at fintech from a competition law perspective. But before starting, I have to make a disclaimer. All the views and opinion expressed during this presentation and in the article as well are not necessarily the one of the Bank of Italy. And just to give you a small overview of what I'd like to present today is basically an overview of consumer inertia and the role that consumer inertia is playing from a competition law perspective. That's why, consumer inertia is particularly important where it comes to fintech and fintech innovation. And I'll argue why the data bottleneck problem may kind of be a barrier for fintech startup companies to enter the market and to provide new innovative services. Then the third part will be a kind of investigation of why antitrust enforcement is not fit for purpose when it comes to ensuring access to accounts data and transaction data for fintech firms. And then we'll move to the main thesis of the article, which is what about ensuring competition through ex-ante regulation? And what about designing specific regulatory mechanisms that may allow fintech firms to access the data they need to provide their own services? And then we'll look at the case of the access to accounts rule enshrined in the Payment Service Directive within the European Union. And then if I spare some time, as I hope I do, I will investigate a little bit further the open banking environment, which has been opened up by access to accounts rule and other similar regulatory attempts made in other jurisdictions, such as in Canada and Australia. And then I'll try to outline the difference between fintech and big techs from a competitive angle when it comes to entering the retail banking market and their impact on this industry. Okay, let me start with a question. Why are we more loyal to our bank than to a partner? Indeed, this was the question that the UK Payment Council in 2013 raised when they discovered that people, on average, at least in the UK, used to stay with their bank for 70 years, whereas they stay married just for 11, of course, always on average. This might explain us why consumers are so disengaged when it comes to the retail banking market. But still, and this is some figures more specific about the point, the UK retail banking market investigation carried out by the CMA, the Competition and Market Authority, in 2016, found out that the retail banking market was characterized by very low level of competition. On the supply side, the market was highly concentrated. The four largest banks retain a combined market share ranging between 70% and 86%. But even on the demand side, just 3% of the customers used to switch bank accounts every year. This is a very, very low figure if we compare it with savings products or even with the energy industry, where it is around 30%. That's why larger banks, as has been found out by the CMA, used to charge higher prices than smaller banks to consumer. And this is an evidence of market power. As some of you may not be familiar with competition law, we speak of market power when some firms holding a dominant position may basically behave independently from competitors and from consumers. So they will raise prices without the fear of losing market share. And consumer low engagement basically is one of the main reasons why in the retail banking market, consumer loyalty is not rewarded, but even punished, as was found by the Competition Market Authority. And they found as well that if customers were more engaged with their banks, they were more willing to look in the market what were the other offers, the competing offers offered by competitors. They were standing to gain around £90 per year on average for each consumer, at least in the UK, just for switching his or her bank account. And this is kind of remarkable. And now we move to fintech, because the impact of financial technology in the provision of financial services may actually help consumer to engage better with their banks and to at least make better use of their own data, just to have access to price comparison tools, personalized budgeting application, and a bunch of services that are provided, that may be provided by fintech startup firms or even by banks that are willing to use in innovative ways technological breakthroughs in the provision of financial services. And this massive increase in data availability and a substantial decrease in the cost of computing power are making realistic for fintech to allow consumer to get a better bargaining power vis-a-vis incumbents, which are traditional banks. And these are just some examples of data-enabled service, such as insights into personal expenses, as budgeting, tailored budgeting tools application. These are just some examples, but you can name them. And therefore, customers' transaction data are really valuable for fintech new entrants, but also for consumers. And that's why it might be really important that policymakers ensure that there are no economic frictions to new entrants to provide this kind of services for consumers. But now we face a data bottleneck problem. As we describe in depth in the article, a lot of fintech services may be based on exploitation of transaction data or customers' account data. And because at least in the payment service industry, which stays at the forefront of fintech innovation, at least when we start writing the article 2 years ago, was a kind of a really interesting cases, because there were new fintech firms willing to provide analysis based on the transaction data of customers, or budgeting analysis, reporting analysis, or even firms developing mobile application to allow customers to pay with their mobile phone and filing an order to their bank to allow and execute the payment. But still, banks used to maintain a very tight control over the client's accounts data. And this is kind of reasonable, both for security consideration, but also for competitive reasons, because banks lacked any incentive to share consumers' data with downstream companies or potential new entrants, because the main concern would be to end up as dumb pipes for banks, or to be kind of disrupted one day by a new entrant with a very competitive business model, or at least being disrupted when it comes to the interfaces and the interaction with customers. That's why this concern has been defined as ending up as dumb pipes. So what about ensuring data access through antitrust? Again, as some of you may not be familiar with this concept, we investigated, I will explain you the essential facility doctrine, which is one of the main tools under antitrust enforcement, in the antitrust enforcement toolkit, to ensure access to a resource which is considered essential from a competitive perspective, at least to allow competitors to stay in the market, providing their own services and products. It has been developed in the 1912 in the United States and was transplanted in the European Union by the Court of Justice case law throughout the past years. And it was really interesting because the Dutch authority, competition authority, in 2017 pointed out that the data held by banks might be considered essential for fintech new entrants if they're willing to provide data-enabled services. Because let's say the data held by ING about their customers are not available to other banks or to or not to mention other fintech firms. That's why ING might be hold a facility, this data was essential, and therefore we might look access to this facility for the benefit of new entrants and other fintech firms. However, essential facility doctrine, in order to apply, which is kind of a strong restriction to the freedom of contracts, need to fulfill certain requirements, which might be recapped under the umbrella of exceptional circumstances test. And this, as we argue in the paper, it can't really work well when it comes to accounts data, because essential facility was firstly developed for physical facilities, let's say a bridge, which is really important for railway service, for instance. But when it comes to data and these digital facilities, something like data sets, is really problematic to show how the data are going to be used by the fintech firms, because in many cases, fintech firms do not know already how they are going to use specific kinds of data. Once they have access to data, they may find useful way to use them or to develop new innovative services. And then we have an administrability problem of compulsory license. Let's say once you force a bank to share the customer data with a fintech new entrant, how would it work, this kind of access? I mean, should it be an access to in real time? Should be an access of a stream of data from the monopolist to everyone who asks for them? And should this data be rewarded somehow? Should the dominant holder, the bank, be rewarded for having collected all those data? And then what about data protection law? Because of course we need the consent of the customer. And it would be kind of tricky to implement all these, especially if we consider that essential facility doctrine, as all traditional antitrust enforcement, will work on a case-by-case basis. That's why we decided to look at regulation and ex-ante regulation, which for us, it might be very compelling to, it might be the right tool to ensure access to data in specific industry, for instance, in the retail banking industry. And that's what the European policymakers and the European Commission did with the revised Payment Service Directive in 2015. They decided to ensure access to account to two kinds of service provider. AISP, which are account information service providers, and we might think about fintech startups willing to offer data-enabled service based on the accounts data, let's say budgeting tools, price comparison tools. By looking at the transaction data of a customer, they will provide him with all the potential choices he has to look for in the market to choose for other products. And then payment initiation service providers. These are fintech startups or even other banks that are willing to provide mobile application or anyway an interface to help the customer to order a payment to his own bank without relying on a credit card scheme, for instance. This is the access to account rule enshrined in the Payment Service Directive. And of course, it's based on the explicit customer consent, because it couldn't work without the consent of the customer at stake. But then we move to the regulatory technical standards, because what's really important, as understood by the European Commission, is ensuring that this access to accounts data takes place in a safe way, ensuring the integrity of the data shared, but also the security and a shield against the potential cyber fraud. That's why the European Banking Authority was entrusted with the task of developing a level 2 legislative process, which are regulatory technical standards or technical rules that need to be complied by banks and by fintech seeking access to this data. And I will be the second one today to mention coronavirus, because as this wonderful workshop is taking place online due to the coronavirus outbreak, I'm sure you'll be glad to know that PSD2 is giving a small contribution in the containment of this pandemic. Indeed, the European Banking Authority encouraged payment service provider to make use of the strong customer authentication exemption for small sum transaction, especially to ensure that payments are made through e-payments rather than cash or coins, so to reduce the likelihood of spreading the virus. This might be interesting. This is the word before PSD2, basically, where a consumer and a merchant had to rely on, let's say, on a credit card scheme to perform a contactless payment. And this will require to have an issuing bank and an acquirer bank to interact within the credit card scheme. Whereas in the after the Payment Service Directive, the parties can act as payment initiation service provider or work with one of a fintech startup offering this kind of service to simplify the flow of transaction and payment. And this will disintermediate, of course, even credit card schemes, and will reduce maybe friction to commerce and transactions. But the second takeaway of our article is that the access to account rule, of course, is compelling and fascinating, but need to be implemented in the right way if we want it to work effectively throughout the market. That's why application programming interfaces, commonly known as APIs, which should be meant as kind of set of protocols under which softwares may be developed so to ensure communication between different entities to share data, need to be developed in a standardized way. And that's the point we make in our article, because the Payment Service Directive doesn't say anything about how API should be developed. And for us, it's really important that they should be developed in a standardized way so that each fintech firm is able to access the data regardless of the bank providing them by using just one common set of APIs rather than complying with the APIs developed independently by each bank. And that's what has been done by the CMA with the Competition Market Order of 2017. Basically, the CMA, by using a specific tool within the British Antitrust Enforcement Toolkit, decided to order the 9 largest banks in the UK to sit at the same table and develop one common set of APIs so that to allow each potential entrant to use it as smoothly as possible to access the data provided by bank. And this is really fascinating because from an antitrust perspective, we are moving from supply side intervention to demand side remedies that might represent the new frontier when it comes to overcoming consumer inertia. And fintech in this case provided a wonderful example because the access to account rule is a regulatory remedy, even the one enacted by the CMA in the UK, which builds on the Payment Service Directive framework, and looks at encouraging and incentivizing the engagement of consumer and empowering them with a strengthened control over their own data by allowing fintech firms to use them to provide them with additional services. And then, of course, we have a global way of open banking initiatives because many other jurisdictions decided to follow suit. Australia, Canada, Singapore, and all the remedies enacted by these states are based on ex-ante regulatory mechanism to ensure a smooth data access, at least in the retail banking sector. And we wonder in the final part of our piece if fintech innovation is real disruption, because empirical studies, as already pointed out by Georg and Luca, there might be more friends than enemies. There is much space for complementarity and cooperation, but still there might be another risk raised by big tech, because big tech platforms, let's say Amazon, Google, or generally speaking, big companies based on platform business methods may use this kind of access to data to enter the retail banking markets, providing their own services as well. And this, of course, might disrupt the retail banking markets, because we're not speaking about small startups, but big tech companies already having huge resources and huge technologies to harness. And this might be kind of disruptive within the retail banking sector. And then this is the new frontier of antitrust, based on a regulatory responsibility of banks, because banks may work as platforms as well, and this will mean that the banks will have to carry out a regulatory role, because they will provide their own services, but at the same time they will have to allow fintech firms to have access to their own infrastructure. And we need to make sure, especially antitrust authorities need to make sure that they do not exploit their own position to foreclose in a surreptitious way fintech operating by access to their data. And this basically is the new framework opened up by the access to accounts rule. We can see that by sharing API, the bank will compete with third-party apps on its own infrastructure. That's the conclusion of my contribution, and I'm sorry if I took some more minutes than what I was intended, but still, these are the main takeaways. I mean, access to account rule might be the right remedy for ensuring access in the fintech market. And then what about big tech? They may rise the huge problems, because they may take advantage of these regulatory measures that were thought for small startup fintech firms 5 years ago, but now may open up a vast array of other consequences from an economic perspective. And finally, the demand-side intervention might be the new frontier of antitrust enforcement. That's all. Thank you for your attention.
At the outside, I want to say that unfortunately, I'm not a competition nor an antitrust lawyer. So all the really fascinating things I've learned in Oscar's paper, I won't be qualified to remark upon in depth. So my remarks go to a couple of different issues I've noticed while reading the paper, but just as a preliminary remark, thanks a lot for this great paper and the stuff I could learn. Now, the key assumption, obviously, of PSD2 is that we think competition in this area is a good thing and that we want to encourage it. Now, you've already remarked upon the problem big tech might pose. And my first question to you is, have we maybe underestimated the impact of, what people call GAFA, so Google, Amazon, Facebook, and Apple? Have we underestimated the way markets are going to change, especially for the European banking portfolio, or the background of how European banks, with a very different setup than both US banks and even more evidently US big tech players, operate by opening up a form of competition in the way PSD2 has done it. So by opening it up in the way the sharing platforms work and giving access to big tech players, which we might not have understood beforehand, in the sense that now probably, but again, not being competition law, but now probably a way or a form of competition has been opened, which we might not have envisaged before. The next question is a similar question. So you say open banking is sort of a testing ground for the application of behavioral consumer protection remedies. I thought it was an interesting remark because it's true, but it then entails the question, obviously, what if not? What if these remedies, which behavioral thinking suggests, don't work in the way we would hope that they will work. So to give you one example, which I think you also mentioned in your paper, the study by the FCA, they say, well, some of it might work really well, so that we actually encourage customers to change accounts, that we actually encourage them to look for different types of credit agreements, different type of contracts, better interest rates, et cetera, et cetera. So at the outset, this seems like a great way to encourage competition and to get us to a better level to, you know, drive prices where they should be. However, what about the opposite threat, right? Isn't that a threat of a race to the bottom? If we're looking at countries where credit markets are already significant and deep. So if I'm a traditional European bank now faced with competition, not only in my own country, but also across the European Union and possibly globally, is this a healthy form of competition which we're encouraging, or is this going maybe too far? And are we opening European banks up to a race to the bottom rather than a race to the top? Now, the last question is expanding on something I am working on myself, which you only hint upon in the paper, but which interests me very much. So I'm quoting you here as saying, well, admittedly, this poses risks of discrimination because of the opaqueness of algorithm-based decisions. Consumers could end up surrounded, tricked, and ultimately damaged. So I want to set the stage a little bit for my question. Now, what is an algorithm-based decision in this context? To give you an example, I would like to use credit scoring. Now, credit scoring as we know it, especially in the US, but also, for example, in Germany, looks at a specific number of questions and parameters. You know, they might check how much you earn. They might look at what type of collateral you can provide. They might look at how stable your job is, et cetera, et cetera. Now, there's new types of scoring outfits which look at very different things. They look at what people call your digital footprint, right? So they might check your Facebook account, they might look whom you're connected to, they might look at your background in terms of education. They might also look at how many typos you make in a text message, or how quickly you fill out an online page, et cetera, et cetera. So where does the algorithm come in? Well, the algorithm tries to correlate these variables, and you can pick any or a lot of them. So correlate these variables with, I'm getting a message here. Well, I don't know.
Ignore it, please.
Huh?
No.
Is this something from me?
No.
No, it's good. Okay, perfect. So the problem I was going to address is, how does the algorithm work? It correlates any of the variables I've just mentioned with the outcome I'm interested in. So the most obvious outcome would obviously be, will this person be able to pay back the credit? Another more specific outcome could be, well, even if this person is not able to pay back the loan, might that person at least pay back a significant amount of it at a very high interest rate? Thinking about payday loans, for example. So if this happens, and are we not maybe encouraging this form of, for example, scoring or using the data you get access to by opening up in the way the access to account rules allows for, by opening up data? What does this entail in terms of problems for three parties, for consumers, for supervisors, and confusingly enough, even for those who might use those algorithms? So for consumers, evidently, you've raised the data protection problem. Are we aware that this is what's happening with our data? Are we actually aware that other entities are going to look at our, be it Facebook profiles, be it whatever else we're opening up via the APIs? that this will not only be used in the context of a specific payment transaction, but might be used for very different purposes, namely to possibly assess my credit score. The next question is, will it be understood by supervisors? How do they figure it out would be a first question. Does a financial supervisory authority know that this is what's happening? If they know, what is a good way to control it? Are there input-oriented regimes of checking what type of data is being used for other purposes than the ones which are apparent to the data subject? Are there output-oriented versions of understanding what type of person gets a credit, what type of group gets a credit, as opposed to with or without these scoring methodologies? Or are there procedure-oriented checks to make sure that whatever data is taken is processed in a way which conforms with regulatory standards? Even worse, it's one question if the bank only uses it for, let's say, a background assessment of its own customers, possibly based on its own data only. For example, where do I shop? Do I go to the organic store or not? What does this say about my own credit worthiness? But taking it further, what if the bank decides to also use that as a basis for assessing rating in terms of capital ratios, right? So do we face the pressure of maybe this form of assessing customers entering into creditworthy assessments, not only on the individual level, but also on capital ratios? Lastly, maybe not even those who use them understand them fully. That's what you hint at if you talk, when you talk about the black box problem. So indeed, it's been suggested that it is not necessarily the case that the entity applying algorithms will understand how the algorithm works and possibly what type of discrimination it might entail. Because other than classic cases of discrimination, the bank is usually not even interested in discriminating against someone. It's interested in what economists call statistical discrimination, in the sense that it's only interested in distinguishing more and less creditworthiness groups. So none of the three parties involved necessarily understand what's happening. And so the question, to sum that part up, is, do you have the feeling that this is something we've overlooked or underestimated in the context of PSD2? And very lastly, 2 seconds only on financial inclusion. I've seen with interest the coalition between fintech and development aid, which is something which surprises me somehow, and I look quite skeptically at this coalition pushing for supposedly enhanced financial inclusion via fintech companies. While I, in the first place anyway, doubt that these fintech companies are out for charitable reasons, I have more concerns in terms of competence and education of the people using what you've termed mobile phone payment systems, for example, in the developing world. Will they really understand what they're doing? Will they knowingly consent to sharing their data for other purposes? Will they be more vulnerable to fraud and scams? And lastly, interesting, one study recently had pointed out, which you might have read about even in The Economist, that while we would assume that somebody in the developing world would be quite open to sharing his or her data in return for something interesting, such as a good credit, that study suggested that it's actually not the case, and that people in these countries are even more wary than the traditional Western consumer if we're talking about sharing their data. So that last question is your take on financial inclusion, and if you think that fintech provides a good, meaningful step towards financial inclusion, or if you have a rather skeptical outlook. Thank you.
Many thanks. Katja, Oscar, would you like to briefly respond?
Yeah, thank you, first of all, for all your suggestions and your question. They are really compelling. I don't think I have all the time I'd like to have for replying them, but just starting from the first question, yes, I think that big tech raise a huge problem when it comes to data sharing, at least in the retail banking market, because as we point out in the article, the access to account rule was firstly thought for the access of fintech startups. But now, actually, the problem is that it might be used by big platform companies, as I said. And we really don't know how to address this problem apart from applying a sort of regulatory responsibility on these platforms. But these have some drawbacks as well, because it will be a kind of rules specifically thought for around some companies, let's say the GAFAs, Google, Facebook, Amazon, and this will not really work well from a business neutrality perspective, we think. So it could be problematic as well. But this is the approach that has been likely taken by the European Commission, by the many reports developed so far by antitrust experts. And then what about the race to the bottom, your second question, about harnessing the data of customer? Is it going too far? Well, maybe, yeah, this can be a problem, but also to answer the third and the fourth question, which are about how these data are going to be used, I'd say that there are pros and cons. The pros is that there are a lot of people, individuals that are unbanked, they don't have access to banking services, and by allowing them to share this data with banks, they might kind of improve their credit worthiness profile. At the same time, we need to be wise, cognizant of the fact that this data might be used to discriminate consumers as well, or to take advantage of them just by using the information they left on the internet, on websites, in the online world. And this, of course, is a huge problem, but can be addressed. In fact, it had been addressed by the Payment Service Directive by providing a clear-cut framework and regulatory limits about how this data can be used and what account information service provider can do with this data. But they have to delete them after they have used them. Of course, we have to see how this is gonna work in reality in the market, because of course there is always room for avoiding or overcoming these regulatory limits. And will supervisors be up to the task? Yeah, this is another problem as well. And the debate at the moment is about setting up a digital enforcement authority that will have the goal of cross-sectional looking at the market, at how data have been exploited, and coordinating the other sector-specific supervisors, let's say antitrust enforcers or financial supervisors, and to coordinate their action in order to make sure that there are no disadvantages, spillovers, or some specific area of regulation. But still, we have to see how it works and if it can be done effectively. And then what about the data sharing? And what about the reaction of consumers? Then I will stop here because I don't know if I still have time, but I think this is really crucial, as you pointed out. I mean, the reaction of consumers to these regulatory mechanisms, because what we say in our article is that the access to account rule is for us to a certain extent is a huge bet taken by European policymakers, because this is a rule that might be used by consumers, but if they do not embrace it, it might remain a dead letter law, because actually it's all based on the reaction of consumers. And many scholars started speaking about smart consumers paradigms, because all these regulatory mechanisms are based on the paradigm that individuals and consumers should really take advantage of these regulatory mechanisms that allow them to harness their own data, but we still don't know if they're going to use them. I mean, I can still say that these fintech firms are supposed to work on the side of consumer. Their interest is supposed to be aligned with the one of consumers. So they should work to provide a nice customer experience for them, to allow them to engage smoothly and in a facilitated form with this kind of data. But we still have to see if they manage to do it or not.